Hi, everybody, and welcome to this quarterly update. I'm Sumera Abdi, and with me is Gaurav Mehta, the Chief Investment Officer of our alternatives business. And to begin, I think from Gaurav and myself and all of us at SBI Funds Management, we wish you a very, very happy new year, right?
Absolutely. Wishing all our investors a very happy new year.
Okay, but we've had a great run. But the one thing that everybody wants to know about is what's coming in 2025. So, what is it that you're looking out for? What are going to be the big themes, big moving pieces?
Right. So I think first of all, let me be very clear that when we are constructing our portfolios, in most cases, we are looking at 3 years and beyond. So to that extent, what's happening over the next few months or quarters is not something that we build our portfolios around. That said, I think it's always good to keep a context of the market in mind. And before I talk about 2025, if we look back on the year 2024, you'll see that it was almost a year of two different halves. And in the initial part of the year, you had a lot of optimism in the markets. So you had a lot of these cyclical sectors do very well, whether it's defense, whether it's railways, whether it's industrials, PSUs, PSU banks, metals, and so on. But when you look at the second half of the year, a lot of these sectors have actually taken a back seat. If anything, many of these stocks have corrected quite significantly from their highs. And on the other hand, consumer, healthcare, IT, I think those are the sectors that have started to do well. So there's been some sort of a defensive shift from a sectoral standpoint. Similarly, when you look at style performances, value stocks were doing very well in the initial part of the year, but in the second half of the year, you saw quality starting to stage a comeback, which again tells you that the markets have undergone a bit of a defensive shift. And similarly, when you look at the market breadth was very strong in the initial half of the year. A lot of stocks were outperforming the indexes, but that breadth has now started to weaken somewhat. So I think from all points of view, whether you look at sector performance, whether you look at style performance, whether you look at the overall market breadth, it looks like markets have taken somewhat of a defensive tilt. And when I look at our asset allocation framework and use that to sort of justify this, we think there were three things that were happening, till about the middle of this year. A, valuations were very expensive. That meant that you should see some consolidation, which is what you're seeing now. B, equity market sentiment as measured through our proprietary framework, that had suggested very stretched and very euphoric market sentiment levels, which again needed to ease off. And I think through this process of consolidation and this defensive shift, that's happening, which is a welcome change. And thirdly, on earnings, you've now started to hit a bit of a slow patch. And this is also leading to analysts downgrading their forward-looking earnings estimates. So this combination of slow near-term earnings, expensive valuations to begin with, and a stretched market sentiment to begin with, I think is leading to this defensive shift. And heading into 2025, we think that some of this ease off will continue, and to that extent, you may have a few more weeks or months of this consolidation before things start to turn better. But I think for long-term investors, and which is I started by saying that we look at 3 years plus. For long-term investors, the interesting piece is that you're still in a very constructive earnings cycle, and we measure the earnings cycle through a simple ratio: corporate profits divided by India's GDP. And this ratio was constantly rising between 1999 and 2008. And that 8-9 year period we remember as a very good period for Indian equities. Between 2008 and 2020, this ratio was constantly declining. So profits growth were very anemic when compared to nominal GDP growth. And we know that was a period which was a bit of a lost decade for Indian equities. And it's only since 2021, over the last 3-4 years, that you've again started to see a reversion higher in this ratio, which is that profit growth has again started to outpace nominal GDP growth. And that gives you sort of, gives you hope that you're still in early or maybe mid stages of that earnings expansion cycle, which usually lasts 7, 8, 10 years at one go. And which is that from a 3 years plus point of view, we still think that you will have relatively decent earnings growth, and that should continue supporting equities. So yes, I think time to be a little patient from a here and now point of view, but the long term continues to look attractive.
So the crystal ball continues to look optimistic. So Gaurav, now let's talk about SBI Optimal Equity, which is the AIF, right? Now, over the past few months, this long-short strategy has delivered robust results. But, in the event that there would be a big market correction, right? 2008, 2020 kind of situations. How would a strategy like this react?
So, Sumera, the concept of a long short fund is that you have the ability to go short as well, right? Which, from a risk reward point of view, means that you're not only focused on generating superior returns, but you also have the ability to curtail risk when it hits. Now, when you look at this fund, last 3 years have actually been, last 3 months rather, have actually been very turbulent for the broader markets. But the fund has done pretty well over this 3 month period. Uh, the reverse will also hold true, right? In a long short strategy, if you're running conservative portfolios, if there is a significant run up in market in a short period of time, you will trail the index. But broadly speaking, our objective in this fund, so the way we run it is that about 70% of the portfolio is always in long-term stocks, and then we have a derivatives overlay on top of it, so that we can move from 0 to 130% in terms of the net allocation through that overlay of derivatives. The eventual intent is that we should still be able to create Nifty plus returns on a cross cyclical basis. But when risk hits, when there's a big drawdown in the market, we want to fall less than half of the index's drawdown. So, the episodes that you talked about, for example, in 2020, the index fell 40%. Our endeavor would be to fall less than 20 during that time frame. In 2008, there was a 60% drop in the index. Our endeavor would be to fall less than 30. So this is not a capital protected structure. It's not an absolute return structure. This is equity biased. But the idea is to generate index plus returns over a cycle, but cut down the drawdowns to half of the index's drawdown when risk hits.
Okay. So, which is a fair thing to do, right? Because a part of the portfolio also needs drawdown protection. But, since inception, it's had about 55-60% in equity, right? Which is stocks. You mentioned that there is this derivatives portion and as an overlay on top of this. So is this the role that it plays, which is only drawdown protection, or is there more of a role that derivatives have?
So you're right. Since inception of this strategy, which was July of 2022, about 2.5 years back, we've had less than optimal equity allocation. The neutral equity allocation on this product is 70%. We've had 70% stocks throughout this period, but we've also shorted Nifty, so that I think the net allocation has moved from maybe 50% to 65%. So you're right that the average would have been around 60 odd percent. This asset allocation decision on whether we want to be at 0%, whether we want to be 130%, or whether we want to be at 70, 50, 60, etc., is driven by our asset allocation framework, which looks at market valuations, market sentiment, and earnings put together with respect to deciding when to move where. Now, on that front, unfortunately, for the past 2.5 years, we've hardly had any situation where valuations have been very attractive or market sentiment has been very pessimistic. Those are the trigger points for us to increase equity allocation. If anything, we've been in an environment where either valuations have been expensive or sentiment has been stretched, or both, and which is leading to this less than 70% allocation on an overall basis. That said, there will be market environments. For example, think of the post-COVID crash period, where valuations will be attractive, where sentiment will be pessimistic, where earnings hopefully will be at a trough. And at that point, we also will want to go to 130% in terms of the in terms of the overall equity exposure. So this is a dynamic product where we move from 0 to 130, but these moves to 0 or to 130 will happen in very rare situations. 70% is the neutral, but given the way our asset allocation framework has been guiding us, it's been around that 55-60% mark for the last 2.5 years. But the role of derivatives here is not just to hedge or reduce equity exposure. There will be times, and we're looking for those low risk entry points where we would also want to swing to the other extreme at 130%. But again, we'll wait for our asset allocation framework to guide us on an objective way towards that, rather than taking a subjective view on it.
Gaurav, thank you so much once again, and we wish you all the very best for this year.
My pleasure, Sumera, and once again, I would want to wish all our investors a very happy 2025. Thank you.